Hello and welcome to Finance 302. Throughout this course, I'll be posting a brief synopsis of each chapter. So the best way to study for this course is to pull up the PowerPoint slides. This publisher actually has a really nice, really good PowerPoint slides that I think the PowerPoint slides are very helpful in understanding the material. And so the way I would study for this course is to pull up the PowerPoint slides and then go through the synopsis with me. So each synopsis, I'll be going over the slides. I'll have it shared to the screen so you can look at that first and then take a look at the PowerPoint slides on your own. Make sure you understand all the examples that I've gone over on the slides. And then from there, you can go to the book, and whatever's mentioned in the slides, I would read that material in the book and focus on that. The book has a lot of detail, so it can be a little bit overwhelming, but if you focus on the slides first and then go from the slides to the book, I think that'll be helpful. Also, the homework is very important, so make sure that you can do the homework and understand the homework. And then also, I do have study guides for each exam to help you. Feel free to text me or email me if you have any questions during the course. All right, so let's start with a synopsis of chapter 1, which is an overview of financial management. So what we're going to be talking about in this chapter is the forms of organization. There's actually 3 forms of business organization. And we're going to talk about how value is created for investors, and then conflicts between shareholders who are owners of the company and managers, and conflicts between debt holders, meaning bondholders and stockholders. And then finally, we're going to discuss, can a company behave ethically and still be profitable? All right, so this is what the typical flow chart of a financial organization looks like. You have the board of directors, and the CEO or the chief executive officer answers to the board of directors. Then under the CEO, you have the chief operating officer, handles all the operations of the company, such as the production, marketing, HR, and any of the operating departments. Then over here, you have the chief financial officer who heads up the financial end, accounting, finance department, and so forth. Now, these are the 3 forms of business organization. So it's important to know the forms and know the advantages and disadvantages of each one. Also, realize that the typical evolution for a company, a lot of firms don't start out as corporations. They start out as a sole proprietorship or a partnership and then become a corporation. So that's one path. You can have a sole proprietorship that just stays a sole proprietorship, partnership that stays a partnership. You can have companies that are firms that just become incorporated. But a typical path is for, let's say you start as a sole proprietor, someone has a small business and they have a product or service, and then maybe they want to take on a partner to increase their capital. They might take on a partner. And then after that, they might decide, well, if we incorporated, we could sell shares. If we became a publicly traded company, public corporation, we could sell shares of our stock and generate a lot of revenue or generate a lot of capital to expand. And so that's typically what can happen. So one example is Crocs. Crocs shoes was a partnership. 2 guys started Crocs shoes, and then they wanted to really expand. So they incorporated, became a publicly traded corporation, and then they really expanded. And so just wanted you to understand, you can start out as one of these types, but you can always change too. And as proprietorships and partnerships grow, they may decide to incorporate. The majority of organizations in this country are sole proprietorships, over 80%. But the majority of sales comes from corporations because you have these large corporations. And then also remember that A corporation can be a privately held corporation or a publicly traded corporation. So let's say that you're a sole proprietorship or you're in partnership with some people and you decide to incorporate. You can be a corporation and have shares of stock, but just keep it among yourselves. It can be a private, what we call a privately held corporation. So there's a lot of corporations out there that we as investors cannot invest in because they're private corporations. One of a large privately held corporation that you would be familiar with is Mars, M&M Mars, makers of M&Ms. They're a privately held corporation. Members of the family own the stock. And one advantage of being a privately held corporation is that you can basically do what you want. You don't have to answer to the shareholders, public shareholders. Okay, so let's move on and talk about the advantages and disadvantages of each of these. So the advantages and disadvantages of a sole proprietorship and a partnership are basically the same. They're easy to form. You just, for example, if you decide you're going to get into the tutoring business or say, get into the landscaping business or be a pet walker, those are popular these days, or, be a nanny, you're a sole proprietor. And you really don't have to do anything. If you want to, you can apply for an EIN, employer identification number, with the IRS. If you have sales income of a certain amount, you're supposed to do that, but that's basically it. And when you file your taxes at the end of the year, you file what's called a Schedule C. That's your income from a sole proprietorship. And that's the income from the Schedule C just flows back to the first page of your Form 1040. So if you do your own taxes, on the front page of your tax return, it'll say wages, W-2 wages, and so forth. Interest and dividends is the second line, and then the third or fourth line is Schedule C income from sole proprietorship. So as a result, one of the main advantages of a sole proprietorship and partnership is that you pay taxes at your personal income tax rate, which is lower than the corporate tax rate. So there's no corporate income taxes with a proprietorship or a partnership. So generally, the taxes are lower because the individual tax rate is lower than the corporate tax rate. So the main advantage of a proprietorship partnership is lower taxes. You don't have to pay the corporate income taxes. Other advantages are it's easy to form and it's subject to few regulations. Okay, let's look at the disadvantages. The main disadvantage is this unlimited liability. So if you mortgage your house and max your credit cards, take out loans, borrow from friends and family to start up a company, start up a sole proprietorship, and you lose everything, you've lost everything. If you get sued or something, you're on the hook for the liability. So there's unlimited liability. So you hear about this, unfortunately, a lot of times small businesses fail. And I've heard of people losing their homes and such because they've taken out second mortgages. So you have this unlimited liability as a sole proprietor. Partnerships, same thing. It's just a partnership is just two or more people. That's the unlimited liability. So that's a disadvantage of sole proprietorship and a partnership. Also, the limited life. What happens when you're ready to retire as a sole proprietor? Well, if your kids don't want to take over the business, or if you don't have anybody to sell it to, the business will probably die. So it has a limit. These sole proprietorships and partnerships can have a limited life. Also, it's difficult to raise capital. What if you wanted to raise some capital? And by raising what we mean by capital is money. We want to raise money to expand. So if you're a sole proprietor partnership, you can go to a bank and try to get loans, but that's going to be somewhat limited. You can try to find what we call angel investors. Those are investors who want to invest in your organization because they think it's, they're willing to put money in because they think they're going to get a good return. So you can find angel investors. You can go to a bank. You try to come up with as much money as you can on your own. You can borrow from friends and family, not recommended. That's the best way to lose friends and ruin your relationships with your family. But that's how you can raise capital, but you're limited as opposed to a corporation where you can just issue more stock. Okay, so these are the main advantage. These are the advantages and disadvantages. We're going to come back to this. I want to talk about corporations first before we come back to this last line. All right, so a corporation, what are the advantages of a corporation? Well, with a corporation, the owners are the shareholders. So whether the corporation is publicly traded or privately held, the owner, anybody who owns a share of that stock is an owner. And so, for example, if you open up an account today, some of you might be familiar with Robinhood. That's an app where you can buy and sell stocks through your phone, online too, but there's an app. They make it super easy to get into the stock market. If you go in and buy one share of Apple, costs around $300. You're a part owner in Apple. All right. So you have limited liability with a corporation because as a shareholder, you're a part owner, but your liability is limited to what you've put in. So let's just say Apple, let's say I own one share of Apple for $300. Apple, just fast forward maybe 60 years and Apple is going bankrupt. It could happen. I mean, that seems crazy today, but if I asked somebody 30 or 40 years ago, would Polaroid be bankrupt or would Kodak be bankrupt? Those companies have actually gotten close to bankruptcy. People didn't, you don't know what's ahead for the future. But anyway, if a company went into bankruptcy, you're only liable for what you've put in. So you would lose your investment. So that's what we mean by limited liability with a corporation. Very easy to raise capital. You issue stock and you can issue bonds or you can issue stock. And it's very easy to raise a lot of capital. And that's a main reason why I mentioned previously why some sole proprietors or partnerships will incorporate. One of the main reasons to do that is, well, the limited liability, but I think the main reason is because it's really easy. It's easier to raise capital. So if they want to really expand, they can incorporate. You're all familiar with Ruth's Chris Steakhouse. That was a sole proprietor. They incorporated. They were a privately held corporation, raised a bunch of capital. Now they have Ruth's Chris restaurants all over the world. And then they went public and it's a publicly traded company now. All right. Another advantage, unlimited life. Corporations just go on in perpetuity unless something happens. Some of the oldest corporations in America are the insurance companies, been around for over 100 years. It's easy to transfer ownership. If you want to transfer ownership, you simply sell your shares. If you don't want to own the stock anymore or be an owner, you just sell the shares of stock. Okay, so I would say the main advantage here is limited liability. Okay, what's the main disadvantage? Double taxation. What we mean by double taxation is first you're taxed at the corporate tax rate. So taxes are higher. They don't mention this here, but I would say higher taxes plus double taxation. So the corporate tax rate is higher than the personal tax rate. So that's one disadvantage. The other advantage is double taxation. What we mean by that is if you look at the income statement, you'll see that they're obviously paying taxes. You have your taxable income, you pay taxes, and then you have your net income. So before you get to the bottom line of your income statement, which is net income, you've paid taxes. So a company has paid taxes on their profits. Now, if you remember back from your accounting class, there's two things that a company does with their profits. They pay dividends, or they whatever profits they keep goes to retained earnings. So if a company pays dividends, let's say I'm a shareholder, I get a dividend check or I get some dividends. Well, when I file my taxes, I have to claim those dividends and pay taxes on those dividends. So that's what we mean by double taxation. The profits are taxed twice, at the corporate level and then again at the personal level when we receive the dividends. All right, now these really smart accountants several years ago thought up this really cool scheme that's legal and accepted. And they thought, well, what if we could take the best of both worlds? What if we could come up with an organization that has limited liability, the main advantage of a corporation, but has the advantage of individual taxation, no corporate taxes. So they wanted to have an organization that had no corporate taxes, individual taxes paid at the individual level, yet have the limited liability of a corporation. Well, that's what an LLC or an LLP is, okay? An LLC is a limited liability corporation. An LLP is a limited liability partnership. So you can set up an LLC or an LLP and what that means is that you're not subject, you are protected on your liability. You have limited liability, and yet the profits flow through to your personal tax return, so you don't pay corporate taxes. So that's one of so this is, you see a lot of these. If you see a company and after it says LLC, okay, that's a limited liability corporation. They are limited on their liability and they're paying, the taxes are flowing through to their personal tax returns. Now, when I say limited liability, if you go to a doctor, a lot of times you'll see these doctors set up as LLCs, or if you go to an accountant, lawyer's office, what have you, it doesn't mean that they don't have any liability at all regarding their profession. So they're still subject to being sued if they defraud you or something. So you still are protected. Let's say you hire an accountant and they make a mistake or commit fraud or what have you. You would still be covered there. So the limited liability is just in a general sense. It's not, they don't have limited liability regarding their profession. They're still liable for any mistakes and so forth regarding their profession. Okay, so moving on to the next subject, we're going to talk here about the stock price versus the intrinsic value. Okay, so what we mean by stock price here, this is also called extrinsic value with an EX before it. So what the stock is actually selling for is the extrinsic value. What the stock should be selling for, if it reflected the true value of the firm, is the intrinsic value. So let's talk about Zoom. Okay, we're on Zoom, and Zoom during the COVID pandemic, Zoom went from $50 a share to $550 a share. The date that I'm making this video is January 21st, 2021. The last time I looked at Zoom a few weeks ago, it was down to $350. So that's a really good example. So the stock price, or the extrinsic value of Zoom, has gone from $50 to $550. Now it's down in the mid threes. What is it really worth, though? What is the intrinsic value? That would be the total value of the firm divided by the you take the total value of the firm, you subtract out the debt, you divide by the number of shares outstanding. That price per share, that's the intrinsic value. So what is Zoom really worth at $350 a share? Is it overvalued or is it undervalued? Well, we don't know. So what they're saying here is that because of investor sentiment, news, they call it noise, because of many factors, the stock price might not be a true reflection of the value of the stock, so of the true value of the company. So, but they say in the long run, you have this long run equilibrium where in the long run, they'll adjust. You can have good news and bad news and all kinds of crazy things happening in the world that causes the actual stock price to go above the value of the firm or below the value of the firm. And you have to decide if you think it's overvalued or undervalued. If it's undervalued, you want to be a buyer, obviously, because that means it's going to go up. If it's overvalued, you want to be a seller. But in the long run, the stock price will equal the intrinsic value. That's a true long run equilibrium. All right, and this is just showing the determinants of the intrinsic values in the stock price. So here you have the intrinsic value. That's the true value of the true risk and the true value of the stock. And then over here, you have the stock market price, which is influenced by the perceived risk and what investors perceive, whether they're, whether they are really high on the stock or negative on the stock. Okay, now you can have these conflicts between shareholders and managers. This is called agency theory. And what basically, just think of this. Let's say you're a sole proprietor. You've worked all your life, you've built up this company, but you're ready to retire, or to at least partially retire, take some time off. And so you hire a manager. Well, do you think that that manager is going to work as hard as you worked, or as hard as you're currently working, or have the same goals as you? Probably not, because you're an owner, you're a stakeholder. That manager is a salaried employee. They probably won't work as hard as you work. They may, be on the computer part of the time. They might have some other interests. They're probably not going to act they're not going to be as motivated as you for the company to make a profit. So you have this conflict between the managers and the owners. So in this case, they're talking about a corporation. So they're saying that you have the shareholders, okay, and the shareholders and the board of directors and what have you. The shareholders, their interest is maximizing the price of the stock, making the company as profitable as it can be. And they want the managers to behave in a way that will maximize the price of the stock. So how do you get the managers to act in the best interest of the owners? Well, that's simple. The best way is to have these managerial compensation packages, and that's just a fancy way of saying you tie the manager's pay to the profitability of the company or to the stock price. So this is where profit sharing comes in. If you give the managers a percentage of the profits, if they increase, bonus systems. You can also give managers what's called stock options, where then just real quickly, the way that works is, let's say that at the end of the year, the price of the stock was $100 a share. And I received stock options to buy the shares, to buy stock at $105 in 1 year. Okay, so the idea there is I have these stock options that allow me to buy the stock. It's right now it's at $100. In 1 year, I can buy the stock at $105. So the idea is I should work really hard to get that stock as high as I can, because that's going to make me money. So let's say that in a year's time, at the end of the year, the price of the stock is $120. Well, that means I can exercise my option. I can buy the stock. When I exercise my option, it allows me to buy the stock at $105. I could turn around and sell it at the current price of $120. So stock options are a way to motivate managers also. There's some other ways to try to reduce the manager stockholder conflicts, that aside from these compensation packages, which is the most popular. You can also have direct intervention by the shareholders, where they just basically say, this is what you have to do, A, B, and C. Not as effective, in my opinion, as number one here. Threat of firing, again, not as effective as number one. This one's interesting, the threat of a takeover. Now, what that means is a lot of, think about what happens when a company is taken over. If a company is bought out by another company, the managers of the existing company are usually let go. So if a company, and what kind of companies tend to be taken over? Those are good companies that are being poorly run. So if you have a company that has some value as a good company, but not being run well, being run inefficiently, it can be a takeover target. So the threat of that can cause the managers to perform better. The threat of a takeover could reduce these conflicts because it means that those managers are going to lose their jobs. All right, now the last, then we have just a couple more slides here. You also have conflicts between stockholders and bondholders. All right, so there's two ways that a company gets their capital. They issue stock, or they can issue debt, issue bonds. Now, bondholders, the way stockholders make money is the price of the stock increases, and or they can be paid dividends. So stockholders can receive dividends if the company pays a dividend, or they make money when the price of the stock increases. You buy low and you sell high. Now, debt bondholders, the way they make money is they get a fixed interest payment. So a bondholder knows how much money they're going to get. They're going to get whatever the percentage that whatever percentage that bond is paying. So because of this, bondholders really they're kind of concerned about the company taking on risky projects, because if a company takes on risky projects, and let's say that it's financed all through debt, well, the bondholders really aren't going to benefit from that. So let's say a company takes on a risky project, it's successful, and it makes a huge profit. That causes the price of the stock to go way up. Well, that means that the stockholders have benefited from that, but they didn't take any of the risk, because if the company financed the project with debt, the bondholders have taken all the risk, but they're just still getting their fixed percentage rate of return, and the stockholders are reaping the rewards from it. So because of that, stockholders are more likely to prefer riskier projects, because they receive more of the upside of the project, the profits from the project, where the bondholders just receive these fixed payments. So if there is, the bondholders are going to be concerned about the use of additional debt to take on a new project, and whereas the stockholders would prefer that. So that's the essence of the stockholder-debt holder conflict. Okay, and then finally in this chapter, they talk about balancing shareholder interests and society interests. So they talk about, well, can you be a profitable company and still be ethical, still not pollute the world, not pollute the environment, have society's best interests at heart, and not defraud investors and so forth? And the long answer there, the short of the long answer is yes. If a company behaves in an unethical manner, eventually it's going to catch up with them. And usually companies that are socially responsible are the same companies that tend to be efficient and are maximizing profits. So, of course, this is the textbook answer. In the real world, are some companies cutting corners and making more profits? Sure, that's out there. But in general, well-run, above board companies are the ones that tend to be more profitable and will increase shareholder value. Couple examples of companies that did not do this and really crashed and burned was Enron. Around the early 2000s, Enron committed fraud, and they were bankrupt within a few months, closed down within a few weeks actually. Same thing happened with WorldCom, MCI, WorldCom. Those are just the two of the major ones. And then finally, they don't mention this in the slides, but it's definitely in the textbook, and you need to know this, is what is the goal? So the question is, what is the goal of a corporation? Well, the goal of a corporation is to maximize shareholder wealth. The way shareholder wealth is maximized is by increasing the stock price. Okay, so you might think, oh, well, the goal of a corporation is to maximize profits. That's not really the right answer. The right answer is the goal of The goal of a corporation is to maximize shareholder wealth. Now, they do that through maximizing profits, but the goal of a corporation is to create wealth for their shareholders. And the way because they're beholden to their shareholders, because shareholders are the owners of the company. The way they maximize shareholder wealth is by operating in a manner that increases the stock price. And of course, you have to be profitable to do that. All right, so this is the synopsis of chapter 1. Feel free to email me. My email address is on the syllabus. My phone number is on the syllabus. Email or text me. Give me a call if you have any questions. Take care.